Why does Alhambra have REITs in its portfolios? Here's Joe Calhoun.
Yeah, Bob, we have gotten a lot of questions about the real estate portion of our portfolio, and I think it's interesting. I mean, I think that it's performed, poorly this year, and particularly in September, it was a really, really bad month for REITs. Rates were up, and that certainly had an impact. But I think that we want to blow up some myths today. We want to talk about the way this really works and why we own these REITs. First of all, it is a part of our strategic allocation. This is our Fortress Moderate. Now, I didn't put the percentages on here because I don't know who's going to watch this. I don't like to give things away. But just say it's a moderate portfolio with some portion in bonds. Look, a moderate portfolio, if it was just stocks and bonds, would be a 60-40 portfolio. We tend to carry a little bit less in bonds. But anyway, this is a strategic allocation. And I think people need to understand what it means to be strategic. First of all, strategic is kind of generic. You can see I've just got large cap stocks, small cap stocks, REITs, commodities, gold, bonds. It doesn't say what kind of large cap stocks. This is what a strategic allocation is. A tactical or let me put that differently. So strategy is just an overall plan for achieving a goal. And in investing, it's almost always an asset allocation plan. Okay. So how do we implement this thing? Well, we implement it. That's what the tactical part is. Tactics is how you fulfill and how you complete your strategy, how you implement your strategy. So large cap stocks might be the S&P 500. It might be the Russell 1000. It might be international stocks. REITs might be international REITs or global REITs or U.S. REITs, whatever. Bonds could be corporate bonds or treasury bonds. So the point is, though, that it's strategic allocation this is what our allocation is going to be almost all the time. Now, the pieces of it can change. The tactical part of it can change, but we're always going to own these things, and we're almost always going to own them in the percentages that we set up at the beginning based on risk tolerance. So why do we own these things? Why do we set our portfolios up this way? Well, we set them up because we're trying to diversify. Look, the goal here is to produce a better return with lower risk. And that's what diversification does for you. So when we look at REITs, look at this line here, REITs, and we look at the correlation with large cap stocks, intermediate bonds, commodities, small cap, and gold. And you can see that the correlations are not 1-to-1, 0.82 on large cap stocks, which essentially means that REITs and large cap stocks move together about 82% of the time. You can see that the intermediate bonds, it's actually negative, meaning that if bonds go up, REITs tend to go down. It's not a lot. It's only 0.14%. And commodities, it's about 50%. Small cap stocks, a little bit less than large cap stocks. And gold, about a quarter of the time they're moving together. So what we look at, though, is if we substitute these REITs for part of, say, our large cap allocation, what do we get? Well, we get a slightly higher return, 10.83% versus 10.3%. And this is 50 years worth of data back to 1972. So the average is a little bit higher. Average return is a little bit higher. And it has a slightly higher standard deviation too. But the key here is they're not fully correlated. And so what does that do for us? I put together a simple allocation. And this is not our allocation. This is just one I made up on the fly. So we start with 50% large cap stocks, 10% small cap, 40% intermediate bonds. We get a return of 9.23%. Standard deviation or volatility of 11.37%. This is 50 years worth of data back to 1972. So what if we take 10% out of large cap and add REITs? Well, if we do that, now we got 40% large cap, 10% small cap, 10% REITs, and 40% bonds. We raise the return from 923 to 934, and we lower the standard deviation from 1137 to 1095. Now, look, that doesn't seem like a big number, but if you compound that over 50 years, it's a big deal. And furthermore, we tend to add more than 10% REITs. We actually have a little bit higher allocation. And because of that, the returns are a little bit better. But the point is that this is the way, this is the holy grail. This is what everybody's trying to do. How do I raise my returns and reduce my risk? And that's what diversification does for you. So the other thing is that I've heard a lot of people say, well, look, interest rates were obviously going to go up. And so why did you keep owning these REITs? Well, first of all, I'm not so sure that it was that obvious that rates were going to go up. Listen, I talked about it all last year. Rates are in an uptrend. We knew rates were in an uptrend. But here's the thing. We didn't know when that uptrend was going to end. And furthermore, REITs, people have this idea that, well, if rates go up, REITs go down. Yeah, it doesn't work exactly that way. This little chart up here, this shows this is done on annual numbers. So in years when rates were rising, are falling versus how these asset classes performed when rates were falling or when rates were rising. So if you look out here at REITs, when falling rates and when rates are going down, yeah, they do perform better. 14.2% versus 10.8 for when rates are rising. But guys, 10.8 is not bad. And it's a positive number. The fact that interest rates are going up does not mean that REITs have to go down. Now, look, in this case, they did. But it's just it's not guaranteed, I guess is my point. And the point about we didn't know when it was going to end is really, really, really important. And here's why. When we have a period of rapidly rising rates, significant increases in the 10-year Treasury yield, we see that usually during the increase, you do see a minor downtick in REITs. And obviously stocks don't perform well either, but stocks perform a little bit better. Now, look, these are long-term averages, and these are only for short periods of time. I picked out some times where rates went up fairly rapidly. If you go and look, though, if you look a year out, after the rates stop going up, then the return on REITs is almost 3 times what you get on the S&P 500. So this is a big deal. And the problem is that if you get out, how are you going to know when to get back in? You have to know when rates are going to peak. And by the way, a lot of the return happens really quickly. So you've got to be in there if you're going to make this. So we did not want to sell our REIT position. The other thing is that it is a strategic asset. There are very few times where we're going to own less than the strategic allocation in our portfolios. Now, tactically, we could reduce the strategic allocation to a particular asset class or increase it for that matter. But when will we do that? Well, we only do that in an extreme situation. If we're on the verge of recession or the verge of recovery, those are times where you could make a big difference in your portfolio return by making that tweak to your strategic allocation. But the rest of the time, it's crapshoot, and you don't want to be making those changes because we know that strategically, this allocation works. In fact, look, that's kind of the point of the whole thing. We set up the strategic allocation to perform in any environment. It's not going to be the greatest, the best performing thing in every environment, but it is going to perform well across multiple economic environments. When rates are falling, rates are rising, dollars falling, it's going to perform well. That's why we chose it as our strategic allocation. So we don't want to deviate from it very far because we can't predict the future. So, but we do know, like I said, there are times where we might make that choice, but it's not going to be very often. So we are not in that situation right now. We don't think we're on the verge of recession. And by the way, we said all last year when everybody else was talking about recession and saying it was on our doorstep, we said, no, it's not. And we're still saying, no, it's not. But I will tell you, there are things out there right now that worry us a little bit more than they have over the last year. We'll get to that in a different video. The point is that you didn't sell these things because you didn't know when rates were going to stop going up. And when rates stop going up, these things perform really, really well. So another thing I've heard is, hey, you don't even have to worry about interest rates. You know that commercial real estate is a huge problem because interest rates have gone up because of work from home and nobody wants to be in the office. And there's just all these problems with real estate. Why didn't you just sell this stuff? Well, most of that argument has to do with office. So I want you to look over here. This is the office piece of the Dow Jones REIT index. It's 5.4% of the index. It is not a concern. I mean, yes, it's a concern. I suppose, if everything in the office space failed, then obviously it's going to be a problem. We don't think that's going to happen for a variety of reasons. But the point is, it is not a big part of the index. In fact, the biggest part of the index is retail, which is doing great. And industrials even actually have a higher occupancy rate than retail does. So look, the rest of the market here, the rest of this REIT market actually is in great shape. And I would say too on office, let's just talk about that for a second. This idea that people are going to work from home from now on, that they're never going back to the office, I think is just dead wrong. Look, I run a company today and have since we started this company. It is a work from home type company. We have people spread out all over the place. We don't have offices in every place we have people. I don't have an office in Silicon Valley. I don't have an office in Denver. It was ridiculous to open an office for one person. So I know how hard it is to collaborate and do the things you need to do as a company when you're spread out that way. It is difficult. But the other thing is, I think companies are discovering that employees just are not as productive working from home as they are in the office. And they're not as creative. There's just a lot of reasons why they need to be in the office. And I think companies are really pushing hard on this. We see it every day. Wall Street in particular, they're saying, look, you guys got to come back to the office. The second thing is that I don't think people are going to want to work from home for the rest of their lives. I've read a number of articles recently about Gen X saying that they're lonely. They want to go to the office. Look, in the end, humans are social beings. They want to be together. They want to be in a social atmosphere. And the office is that. And I think that this return to office is going to go a lot quicker than people think it will. But look, that's speculation. The bottom line is that I'm not worried about office because it's a small part of our investment. So I think there's also some misconceptions about the REIT industry. So we're going to go over some things here that people really probably don't know. So first of all, occupancy rate. The occupancy rate for the entire REIT sector is 93.4%, which sounds pretty good. It's a little lower than average. It's not that much lower, but it's a little lower than average. But 93.4 is not bad. But by the way, that includes the office space, which is at 88.4. If you look at all the other sectors, all of them are over 95%, and industrial is at 97%. There's not a vacancy problem in commercial real estate. There's just not. Now, debt. Everybody says, oh, my goodness, they're going to have to refinance all this debt. Well, first of all, a lot of people know about commercial real estate, and they know that a lot of commercial real estate in the private world is done with floating rate debt. And so they're like, oh, well, all these guys are seeing higher interest cost. Yeah, no, they're not. First of all, debt has been reduced dramatically since 2008. Debt to asset levels ratios fell below 40% in 2011. They've stayed there. They're about 35% right now, which historically is very, very low. REIT interest expense as a percentage of net operating income has fallen from 37% in 2009 to 21.3% today. Interest expense is not a problem. And they're not going to have to refinance it all anytime soon. The average weighted term to maturity is 78.5 months, which is about 6.5 years. Look, I don't know what interest rates are going to be next month, much less what they're going to be in 6.5 years. And when everybody talks about, oh, they're going to have to refinance at higher rates, well, you don't know that. And I would just say that my guess is that if a lot of them will refinance, if rates pull back a little bit here, which it looks like they're doing, my guess is a lot of these guys will refinance some of this stuff at a lower rate, get the terms longer on the shorter term stuff. Look, there's a lot of things. They have a lot of flexibility is the point because they've got low debt ratios. Last thing I would say is that funds from operations. Oh, and by the way, this debt that's out there, 85% of it is fixed. It's not floating rate anymore. That's not what they do in the REIT sector. They don't have to go to that floating rate debt like private companies do. 85% is fixed rate debt. All right, last thing is funds from operations. Fund from operations is kind of a cash flow metric that we use to analyze REITs. It's kind of like, put it this way, it's a better way than looking at earnings. There's a lot of depreciation and so forth. When you look at earnings in real estate, it doesn't really tell you much. Funds from operations is more of a cash flow metric. And growth over the last year in funds from operations over the last year is 11.3%, which, by the way, earnings growth in the S&P 500 is only 3%. So we've got a choice here of owning REITs where the growth rate's about 11, or the S&P where it's about 3. Now, look, the S&P is going to get better. I think it probably runs closer to 10 to 12 next year, but that's beside the point. Right now, this year, you're getting 11% out of funds from operations from the REITs. You're only getting 3 out of the S&P. So I think that really this idea that the REIT industry is a problem is really just not true. And I think that we need to work with the facts, and that's what we do. From an investment standpoint, the REITs are good investments. They pay great dividends. They're growing. They're well financed. There's really not an issue with these things. They performed poorly this year, and they pulled our performance down some. We're lagging a 60-40 portfolio a little bit this year, but we also know that when rates peak, which we think is happening right now, these things are going to recover, and they're going to recover quickly. In fact, just today, and I'm just going to check these numbers right now. Just today, let me just see here where I can look at this. Today, the Dow Jones REIT Index was up 3.15% versus the S&P 500, which was up 1.9. And that's just one day. Obviously, it doesn't mean anything, but we had rates down big over the last couple of days, and REITs have performed really well. That's what we expect, and that's what's happening. So look, we'll be back next week. I'm not sure what our topic will be next week, but we'll be back next week with another one of these. And I hope this one was helpful. And I hope you understand now a little bit more about why we own real estate in our portfolios. See you next time.
If you like these videos, give us a thumbs up, subscribe to the channel, and turn on notifications so you'll know when we post new information. You can also subscribe to our free newsletter at alhambrapartners.com/commentary analysis.